Last time, we navigated the ambitious future of Momentus, Inc. Today, we're shifting gears to another intriguing aerospace and defense company, Air Industries Group, traded as AMX ARI. Now, this is a company that makes components absolutely vital, really, to our national defense and commercial aviation. Yet, their financial reports present this fascinating, almost contradictory story for investors. So the central question we're wrestling with today is this. Do Air Industries Group's recent contract wins and, their revenue forecasts truly point towards a promising financial outlook, even with these persistently low, often negative, profitability margins? Or do those historical metrics actually reveal a more fundamental lack of sustainable competitive advantage and ongoing challenges that investors just can't ignore?
I'll be making the case that, recent operational improvements, significant contract awards, and even analyst sentiment, they all point towards a positive, albeit challenging, path forward for ARI.
Yeah, my perspective, however, it does diverge quite a bit. While those recent headlines about contracts are, definitely attention-grabbing, I'm going to argue that the company's long-term profitability metrics, especially when you look at them alongside a consistent historical financial pattern, they expose some pretty deep underlying weaknesses and significant hurdles to sustainable financial health that, frankly, warrant a much closer look.
Okay, well, to elaborate on my side, Air Industries Group is what's called an integrated Tier 1 manufacturer. So basically, they're a direct supplier to the big players, the prime contractors. They specialize in these precision assemblies, absolutely vital for mission-critical aerospace and defense. I mean, their parts are in things like the Black Hawk helicopter, the F-35, F-16, the E-2CD Hawkeye, and also major commercial planes from Airbus and Boeing. And the news flow lately, it's been particularly strong, really showing robust market demand. For instance, they landed an $11 million contract for GTF aircraft engine components back in August 2024. Now, GTF is geared turbofan, cutting-edge engine tech. This was actually the largest contract in the company's history.
That is a big number. Yeah.
It is, and it's not just a one-off. We've also seen a $5.4 million contract for B-52 landing gear components just this past July, and a $33 million one for the CH-53K King Stallion heavy lift helicopter back in December 24. I mean, these are substantial commitments for really critical defense programs, and the company's earnings reports seem to back this up. Q4 2024 mentioned strong revenue growth and record backlog. Then Q3 24 highlighted revenue growth and operational turnaround. More recently, Q1 2025 talked about navigating challenges with strategic growth. So this operational momentum, it seems to be recognized by market professionals too. You've got a consensus buy rating from 7 analysts. Their average 12-month price target is $6.63, which suggests, an upside of over 100% from the current price. Plus, management seems proactive financially. They paid down $1 million of subordinated debt, so paying it down strengthens the balance sheet. And they expanded their term loan with Webster Bank. Looking ahead, revenues forecast to grow almost 5% next year to around $57 million. These all seem like indicators of a company making, strategic moves to improve its position.
Okay, I understand the optimism. I do, especially driven by those big contract numbers and management actions. But my assessment takes a rather different turn when we dig into the core profitability. The picture becomes quite concerning, actually, highlighting what I see as a fundamental weakness in their business model itself. Let's start with the gross margin. Right now, it's sitting at a pretty meager 16.02% as of June 2025. Historically, looking back 13 years, it's hovered around a median of just 14.21%. Now, to put that in context, AIRI's gross margin is worse than nearly 3/4, 73.58% to be exact, of its peers in the aerospace and defense industry. It's significantly below the industry median, which is over 25%. And Guru Focus, a financial data provider, explicitly states that margins below 20% indicate no sustainable competitive advantage. That's pretty stark. It's also critical to note that the 5-year average growth rate for their gross margin was actually negative, minus 0.20% per year. So no signs of improvement there. And beyond the gross margin, well, it gets darker as you go down the income statement. The operating margin is an alarming 0.06% as of June 2025. The trailing 12 months, or TTM, operating income was negative $0.77 million. Again, that puts them worse than roughly 75% of their industry competitors, far below the industry median of about 7.2%. And the 5-year average operating margin growth rate? Flat, 0% per year. Then you get to the net margin, currently negative 3.33%, with TTM net income of negative $0.42 million. Again, worse than 3/4 of their peers. Their 10-year range shows a median net margin of negative 3.31%. It just indicates persistent unprofitability right down at the bottom line. And other metrics just compound this. Earnings per share, TTM, is negative 67 cents. Return on assets, ROA, negative 2.68%. Return on equity, ROE, negative 9.14%. Analysts even project negative EPS for this year and next year. You add in high leverage, a debt equity ratio of 1.73, long-term debt equity of 0.44, it raises serious questions about financial stability. And the stock performance? Well, it reflects this skepticism, down 45% over 1 year and a staggering 96% decline over 10 years. They haven't paid a dividend since December 2015. And maybe most concerningly, we've seen insiders selling from directors just recently in September 2024. Oh, and not to mention recurring issues with regulatory filings, late 10Qs, late 10Ks. These often signal deeper operational or governance concerns brewing beneath the surface.
I appreciate your focus on the historical profitability. I really do. But the sheer scale of these recent contract wins, the largest in company history, that presents a compelling counter-narrative, doesn't it, to this idea of just fundamental weakness? Now, I acknowledge the margins are a clear concern, particularly that gross margin being below the 20% threshold, often linked to sustainable competitive advantage. But we have to consider the industry context here. Aerospace in defense, it often involves incredibly long procurement cycles, substantial upfront investment costs. Air Industries Group is securing business and significant business. That $110 million GTF engine component contract, for example, that's a potential game changer for a company this size. These strategic wins and the record backlog mentioned in the Q4 24 earnings, they indicate robust demand, a solid foundation for future revenue.
It seems entirely plausible, to me at least, that the company is currently in an investment phase, maybe a restructuring phase. They might be absorbing higher costs now to fulfill these complex orders, which could lead to better margins down the line as, efficiency gains are realized or as these long-term contracts mature. The operational turnaround highlighted in Q3 24 and the strategic growth in Q1 25 reports seem to support this view, a company actively working to improve, even if the immediate impact isn't fully visible in the margins yet.
That's a possible narrative, sure, but I find it difficult to reconcile with the persistent data. You suggest it's an investment phase, but what specific evidence beyond, generic earnings report phrases like operational turnaround points to this specific company successfully converting these massive contracts into future margin improvements, especially given its 13-year history of underperforming the industry? These persistently low margins, particularly the gross margin worse than nearly 3/4 of its peers, that doesn't feel like a temporary blip during a growth phase. It consistently indicates to me severe pricing pressure or fundamental cost inefficiencies. If their products really are so mission critical, as you describe, why isn't AIRI able to command better pricing? Why can't they achieve margins closer to the industry median?
The long-term trend of declining or just stagnant profitability metrics suggests, an eroding business model, not just a period of investment that will magically resolve into higher margins later. The data point is stark. Margins below 20% indicate no sustainable competitive advantage. That's a direct challenge to the idea that these contracts alone guarantee future prosperity.
Okay, but shifting to financial stability and shareholder value,
I think we need to look beyond just the raw negative numbers for a second. Yes, there's a high debt-to-equity ratio, persistent net losses. I see that. However, the company has actively engaged in financial management. We saw the paydown of that $1 million of subordinate debt, the expansion of their term loan from Webster Bank. These actions show a deliberate effort, right, to manage and improve their capital structure, not a company just spiraling. And negative ROA, ROE, EPS, while concerning, absolutely, they aren't exactly unheard of for companies undergoing big growth phases or operational restructuring. The Q3 24 report highlighted an operational turnaround. Q1 25 mentioned strategic growth. This implies management is addressing these very issues. And that analyst consensus, the buy with a high price target, that isn't just wishful thinking, surely. It suggests market experts are anticipating an improvement, perhaps forecasting a return to profitability that just isn't reflected yet in those sort of lagging historical margin figures.
My assessment diverges quite sharply there. While, yes, active debt management is a positive step, it doesn't just erase the fundamental facts. High leverage, persistent net losses, negative ROA, negative ROE. A company that hasn't paid a dividend since 2015 clearly isn't prioritizing shareholder returns in the traditional sense, is it? And that historical stock price performance, a 96% decline over 10 years, that unequivocally reflects deep investor skepticism about its ability to create long-term value. Moreover, that insider selling, director selling shares in September 2024, that raises a significant red flag for me. If management is truly confident in this operational turnaround and future profitability, why are key insiders heading for the exit, so to speak? These aren't minor details. They feel like strong indicators of a potential lack of confidence internally about the company's future financial health and its capacity to deliver consistent returns.
Okay, but my line of reasoning for a sustainable competitive advantage really centers on the nature of what Air Industries Group does. As a Tier 1 manufacturer, they aren't just some small part supplier milling widgets. They are directly integrated into the supply chain of major critical programs. They produce precision assemblies for things where failure is simply not an option. Landing gear, flight controls, jet engine parts for the F-35, the Black Hawk. This specialization, it inherently creates high barriers to entry. The expertise, the certifications, the long-standing relationships needed to be a prime contractor to the DoD and a supplier to Airbus and Boeing, that constitutes a significant competitive moat, even if it's not perfectly reflected in their current margins right now. Furthermore, look at the strategic marketing agreement with All System Aerospace International, signed last September. They're pursuing foreign military sales, FMS, selling defense articles to foreign governments. That demonstrates an active strategy to expand their market reach, diversify revenue. This kind of expansion could very well lead to better economies of scale and, eventually, maybe better margins as they leverage their existing infrastructure.
I just remain unconvinced that this constitutes a sustainable competitive advantage when you look squarely at that gross margin data. If this moat is so strong, so impermeable, why is their gross margin stuck down at 16%? Again, the metric explicitly suggests no sustainable competitive advantage, and it's far worse than most peers. The mission-critical nature of the products should, theoretically, allow them to command premium pricing or achieve greater cost efficiencies. Yet the numbers, year after year, consistently suggest they simply can't. This isn't just a number. It fundamentally challenges the idea that ARI, despite making critical components, has actually established a powerful position where it can dictate terms or truly differentiate on cost. It forces us to ask, is the moat really that strong? Or is the defense contracting world maybe structured in a way that inherently caps supplier profitability? The inability to sustain positive net income year after year, that points to either intense competition or some deeply ingrained structural inefficiencies that are just eroding any potential advantage they might have. Expanding market reach is fine, but if you're expanding a business model that struggles with fundamental profitability, well, it doesn't necessarily solve the core issue, does it?
Well, in conclusion, while Air Industries Group certainly faces significant challenges, no doubt,
The compelling narrative of these large strategic contract wins, including that record breaker, combined with active financial management and, yes, a clear analyst buy consensus. It presents a strong case, I believe, for optimism regarding their future potential. The current profitability metrics, while undeniably weak, perhaps should be viewed in the context of a company making substantial strides in its market, with clear operational improvements apparently underway and a substantial foundation laid for future revenue growth.
And to summarize my position, that persistent pattern of low gross margins, negative net and operating margins, it just can't be easily dismissed by pointing to new contracts alone. These fundamental profitability issues, alongside that long history of stock underperformance and the recent insider selling, they raise significant questions about the long-term viability of ARI's business model and its actual ability to deliver consistent shareholder returns, regardless of the current contract activity. The cold, hard numbers, frankly, over an extended period, tell us stories of a business really struggling to generate actual profit.
It's clear that evaluating a company like Air Industries Group really requires a careful look at both sides, doesn't it? You've got the macro indicators like that impressive contract backlog, the positive analyst sentiment, and then you have the granular details of their profitability margins. It's a classic investment conundrum, really. Do you bet on the undeniable demand and the critical role they play, or do the cold, hard profitability numbers serve as a stark warning?
Precisely. There's a real tangible tension between the strong market demand for what they make and the company's historical struggles to actually translate that demand into sustainable profits.